Let's talk to Shaun Richards. He is a Not a Yes Man Economics. Very good morning to you, Shaun.
Morning.
Right, it's your soapbox. Let's the rant begin. You've got 6 minutes. Tell me what's going on in the world.
Okay, well, we'll start off in the United States. There was more to the, I think, Federal Reserve speech from Chair Powell or Jerome Powell yesterday than people are, I think, looking at. And the reason behind this is, in essence, his background thing was that US economy is doing well.
Yep.
So 3% growth, unemployment's dropping. And he made kind of a deal of that, if you look into the detail, pointing out that January had been better than the previous trend. So the sweep of a economy picking up. Then on the undercard were a couple of other things. If we stay with the labour market, he did, in various bits, suggest that wages are going to go up, in his view, this year. There are a few bits in there where he was saying that it's productivity that held him back. He said that productivity he thought was going to pick up. Investment was very strong in 2017. He thinks that'll drive through. So you have there the setting for US interest rate rise, except of course the catch is we're already expecting some of them, so perhaps more. So that moves people to thinking of 4 this year rather than 3. To come back to your rant bit though on that subject, the bit I think that's insane about this is, if you're sitting there thinking that you're going to raise interest rates, why not do it? Why mess around with quarters all year? For example, why not do a half now? Then you can sit back for a bit. Where this is very important is we seem to have sort of arrived at an era whereby people think things happen instantly. No, they don't. If you change interest rates, it takes 18 months to have a full impact. So why not get on with it?
That's a really good question. So it takes 18 months for it to have a full impact?
Yeah. If you play it out fully, 18 to 24 months. So you see, here's a real big issue if you have the job of setting interest rates. You've got to look a long way forward. The information you have is always behind the times. So you're sort of always 2 and a bit years behind. We seem to, though, have arrived at an era where even if central banks think they're going to raise interest rates a fair bit, which the Fed's been giving a go at, but they just go in quarters all the time. Well, why not get on with it, do a half, or even say, if you think you're going to do 3 this year, why not do 3 quarters now? And then say, we think we've set things up, now we're going to sit back for a bit.
Okay, well that's a good question. What else is on your soapbox?
Well, if we stick with the interest rate thing, this is common around the central banks at the minute. The Bank of England, Dave Ramsden, who used to be at the Treasury, this is a real soapbox point. The so-called independent Bank of England is full of ex-Treasury people. So why isn't it still in the Treasury? It all seems a bit pointless. But if we go back to that, he seems to be switching from someone who wouldn't raise interest rates to now saying he will.
Yep.
I'm very careful with my words here, saying he will, because I'm still a bit doubtful about the Bank of England. However, nonetheless, the music's shifting that way. Jens Weidmann, Bundesbank, yesterday, really oddly, was talking about interest rates in 2019 in Europe, saying they might go up. On the one hand, that's meaningless, because by the point I made earlier, if you're trying to say you're going to do something in 18 months' time that will have an effect 18 months later, based on data that's 6 months out of date now, you see where I'm going here, you're
right.
Years out.
Yep.
However, the point is that there seems to be a concerted effort by central bankers to say the same thing. The United States at the minute is the only place that's actually doing it, of course, and getting on with it.
Yep.
Whatever people think of that, it's giving it a go. However, here's an undercut for you. If you look at some of the numbers, there's another side for this. If you take the fiscal expansion Trump view, which Chair Powell was talking about yesterday, the economy will have a run, then that was associated with trade deficits back in the day in the US. Yesterday's trade numbers, now this is just for goods, advanced trade numbers for January, were actually quite poor, as bad as they've been since January 2008. Now there's the first issue, what happened next? Because the other set of numbers that came out yesterday were consumer confidence in the US. Again, very strong. Highest they've been since 2000. You're probably already figuring where I'm going with this now, which is we normally get the numbers that are absolutely fantastic when things are about to go wrong.
Yep. And go wrong, does that mean recession?
Possibly. This is always a sort of difficult one, isn't it? Because the economic statistics as they come out never really ever predict that. It's all the jokes of, economists, or the US Federal Reserve's never predicted a recession correctly, Or the other one is economists predicted 10 out of the last 2 recessions, that sort of thing.
Yeah.
Because the numbers never really get you that. Like I was saying before, they're always 6 months behind, you don't get it. But these sort of signals of people being over-optimistic, like consumer confidence, they can be a turning point. So it'd be interesting to see.
But in terms of stock market tops, invariably everything looks at its best, okay, before the markets tumble over. Do you think we're in innings 9 now and about to tumble over?
Well, possibly, but there's so many things in play because we then come back to the central banks. One of my arguments is, quite a possibility this year, those sort of things play out. It's not impossible. Powell will be raising interest rates, and then we end the year with more quantitative easing, QE4. There's certainly roads to that. Let's say that the US budget deficit starts to run out of control, Trump's extra spending, economy doesn't do quite as well as they thought.
Yep.
So then interest rates, bond yields start going up. Now, at which point will that be too much? These days, that's very tight because the numbers are a lot tighter than they were. So at that point, you could see the Federal Reserve back buying bonds again.
Yep.
And then we're in quite a mess, I think, because then it starts to look like a cycle we can't actually get out of.
But the textbooks, okay, didn't teach me about quantitative easing, negative interest rates. What they did teach me is rising, yields suggest good economic growth. But we're talking about growth in the States at 3%, inflation at 3%, and 10-year money at 3% yielding, okay? And people are saying this may be trouble ahead. What's your take on that?
Well, the thing is that there's one of my arguments is, and whether it turns out on the evidence I was just discussing, whether the Fed's right or wrong in terms of tactics here, having interest rates about 2%, I think that's much more like the right level for 2 reasons. One is, when we went to these negative interest rates you're talking about, I think you get an unfair balance between savers and borrowers.
Yep.
You need some sort of balance for it to work. Borrowers need savers to put the money in so they can borrow it. Savers need borrowers. It went too far one way. And the thing is that in Keynesian economics, this is supposed to be for a limited period of time. Except this is getting on for a decade now. So we're running out of road, I think, on those logic. Trying to get things back to some sort of interest rate. 2% isn't a lot, but let's say it's the inflation target, so might hopefully be a real yield of nothing. I know that's not a lot, but it's something. Because with all the debt around in various places, we've got ourselves in a trap. And it's not really, in many respects, so much the ordinary person, although some of that's true, but it's governments. So many of the things that are running, particularly around Europe, are basically running because their debts are cheap. Look at, say, somewhere like Italy. I saw some numbers yesterday, a Bloomberg chart. Even corporates are not paying much more in general than the Italian government, which is 2 and a bit percent. Now that, from if you're saying in your textbooks, would blow up the computer model. Because if you looked at Italy right now and where it is,
we're back at
5%, 6%, not 2. And so there's been the shift, but just back to my point of timing before, this has gone on for too long, I think.
On that note, young Shaun, brilliant stuff. We'll see you same time next week.
Thank you.